The S&P 500 is widely regarded as the gold standard when it comes to returns on the stock market, with a return of investment of about 10% annually, which is tough to beat. There are a few people who've consistently managed to beat the returns from the S&P 500 by a considerable margin, and one of those people is Peter Lynch. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Peter Lynch is widely regarded as one of the greatest investors of all time. He is famous for his tenure as the manager of the Fidelity Magellan Fund, one of the most successful hedge funds in the world, where he achieved remarkable returns over a 13-year period. From 1977 to 1990, Lynch grew the fund's assets from $18 million to $14 billion, which made it the largest actively managed mutual fund in the world at the time. The fund's average annual return during Lynch's tenure was around 29%, which is more than double the return of the S&P 500 over the same time period. Lynch's ability to consistently beat the market and deliver impressive returns to investors has made him one of the most successful fund managers in history. His investment philosophy, which focused on finding undervalued companies with strong fundamentals and holding them for the long term, proved to be highly effective. Lynch was also known for his ability to spot opportunities in the market and identify companies with strong growth potential, which helped him outperform the market consistently over many years. I would like to look at a few lessons that we can learn from Peter Lynch which can help you do better with your investments. The clips I will share are quite old but are very relevant to today's conditions, which goes to show that good advice never ages and what we are seeing today is not a completely new thing. Number 1. The price of a stock should not be the only determining factor in you either buying or selling. It is important that you get an understanding of what the company whose stock you own or are planning to own is doing and why. Here's Peter Lynch explaining this point.
There's a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. This is a company, it was just so overpriced, it went down. I did the same thing in I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. How much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now unfortunately, this happened rapidly, or I would probably be still caddying or be working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now I learned this very early, this might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky, some people can approach that, it's a real achievement, but they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one is This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know.
The easiest way to lose money in the stock market is to follow trends. The price of a stock is only one of the many indicators of how a business is actually doing. Don't let it be the only one you follow. As Peter Lynch explains it here, it's important to do your research before buying up a stock of a company. He gave a couple of examples of different companies that at one point had their stock price fall. It all looks like the same thing when it happens, but it doesn't all happen for the same reason. If you don't know why it's happening, then you should find out. I also like how you mentioned that when a stock goes to 0, you lose 100% of what you put in. So you should consider that before deciding to YOLO your money into the next meme stock. Number 2, you cannot predict the markets. The market can be volatile. By trying to predict where it'll go, you might lose your money. However, by understanding volatility and microcycles, you can take advantage of the situation.
People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know what hotel occupancy is about. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
The market is made up of a lot of moving parts, but you can learn from history how they work and how you can avoid huge losses. It is very beneficial to understand what is going on in the industry that you've invested in and what the position of your investment is. Peter here also addresses the importance of understanding how the markets work and essentially tells us that with a good understanding of what's going on, you can confidently buy the dip and make good returns. As the famous saying goes, millionaires are made in recessions. So if you play your cards right, who knows, maybe you can make your millions too, or at least move one step closer to them. Number 3, patience will take you a long way in investing. There will be times when things get a bit out of control. Learn to know what you can and cannot control and let things play out.
October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was, not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, in two working days. I said at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, by 12 o'clock, it was, in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. As though I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year.
A good temperament will help you keep track of your investments and help you make the most of situations that you most likely wouldn't be able to identify otherwise. I like the fact that he pointed out that when you play your cards right, your chances of winning are a whole lot higher than those of losing. This is a great advantage to have at your disposal. I also like what he had to say about only needing to be right 1 out of 4 times in order to make great returns on your investment. So don't get bogged down when things aren't always going your way. By learning to diamond hands or hodl, as is common to say these days, you can reap great rewards. Number 4. Volatility is good for the markets.
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
So Peter Lynch is basically saying that volatility, when understood, can be a friend and not a foe. To me, this speaks to the kind of mindset that we need to have in order to make the most of situations that can be viewed by many as terrible times. In his example, he talks of how volatility became a friend to him and his fund because he took time to understand it. We cannot form a good relationship without understanding. That is a huge part of investing. I like how he talked about mutual funds as an alternative to investing in stocks. They offer a predictable return for the most part and don't require too much of you. I made a video a while ago where I explained a little more about them, so if you'd like to learn more, the video is linked in the description. So there you are. These are a few of the lessons that we can learn from the billionaire investor Peter Lynch. There are a number of principles that seem to apply to all 4 points I shared, and understanding the market and the companies you choose to invest in is one that sticks out to me the most. So it all starts with understanding, then the rest will follow. Downturns in the market or even the global economy are not all doom and gloom, at least not for those who have an understanding and are prepared to make the most of the opportunities that present themselves. So go ahead and do great things that will bring you good returns. I hope that you appreciated Peter Lynch's humor and great lessons, and that you found value in this video. If you did, then show some love by leaving a like and sharing the video with a friend. And while you're at it, subscribe to the channel and click on the notification bell to stay informed whenever there's a new upload. Thanks for watching. Hope to see you on the next one, but until then, stay invested.